Oil is falling more than 3%. Is America's Iran strategy backfiring? Imagine spending months trying to squeeze Iran's oil exports. Then, on the day Washington announces another major round of sanctions, oil prices fall more than 3%. That is exactly what happened on August 25th. Brent crude fell as much as roughly 3.2%, reaching about $89.21 a barrel, while West Texas Intermediate dropped to around $82.07. And here's the strange part. This was not a normal market reaction to a successful economic attack. Investors were not looking at Washington's latest sanctions and saying, Iran is finished. They were looking at the same sanctions and saying something very different. Maybe the worst case scenario is becoming less likely. That distinction matters, because if America's objective is to make Iran economically surrender, falling oil prices sound like good news. But if the objective is to force Iran into a political settlement while keeping global energy markets stable, the picture becomes much more complicated. And there is an even bigger question hiding underneath the oil price. What if the United States is discovering that hurting Iran's oil exports does not necessarily mean controlling Iran? What if it simply changes who profits from the disruption? What if China gets cheaper bargaining power? What if American consumers get relief at the pump? What if Iran loses revenue but gains another reason to keep pressure on the Strait of Hormuz? And what if the biggest winner is not Washington, Tehran, or Beijing, but whoever can keep moving oil while everyone else is trapped? That is the story behind today's more than 3% oil drop. And to understand it, we have to start with one uncomfortable fact. The oil market does not always react to what governments do. It reacts to what traders believe governments are going to do next. And right now, that belief is changing. For months, the Iran crisis has created one of the most dangerous energy situations in the world. The conflict began with direct military action by the United States and Israel against Iran in February. The fighting disrupted energy infrastructure. The Strait of Hormuz became a major pressure point, and the waterway that once carried roughly a fifth of global oil and liquefied natural gas flows became dramatically less active. The consequences were immediate. Shipping companies became more cautious. Insurance costs increased. Tankers changed routes. Oil inventories were drawn down. And every time Tehran threatened to restrict energy traffic further, traders had to ask the same question. Could this become the next major global oil shock? That fear pushed crude prices higher. But then something changed. The market started learning how to live with disruption. That may be the single most important development in this entire story, because markets hate uncertainty. But markets can eventually adapt to almost anything. A crisis that looks terrifying on day one can become manageable 6 months later if traders understand the new rules. And that is precisely what appears to be happening. The strait is still heavily restricted. Iranian oil exports have collapsed. Shipping remains dangerous. Yet oil prices are no longer behaving as if the entire global energy system is about to disappear. Why? Because traders are beginning to believe that the crisis can be contained, and that belief is powerful enough to overwhelm the immediate impact of new sanctions. Now look at what Washington actually did. On August 24th, Treasury Secretary Scott Bessent announced expanded economic pressure against Iran. The United States increased pressure on entities and countries maintaining business relationships with Tehran. Washington's strategy was straightforward: reduce Iran's ability to earn money, reduce the ability of foreign companies to help Iran sell oil, increase the cost of doing business with Tehran, and eventually force Iran to make concessions. On paper, that sounds simple. But oil markets are not a simple system. Iran does not exist in isolation. Iranian crude is connected to China. Chinese refiners are connected to global crude markets. Tankers are connected to insurance companies. Insurance companies are connected to banks. Banks are connected to governments. And governments are connected to consumers. Push one part of the system, and another part moves. That is why sanctions can produce consequences that are very different from their intended purpose. And we are now seeing one of those consequences. Here is the first paradox. America wants to reduce Iran's oil revenue. But when the market believes sanctions will reduce the chance of a larger military escalation, oil prices can fall. That creates a strange equation. Less Iranian oil supply should normally push prices higher. But less fear of a broader war can push prices lower. So which force wins? Today, fear is losing, and that is why oil is falling. Reuters reported that Brent to around $89.21, while WTI fell to about $82.07. The market interpreted Washington's latest move not simply as an attack on Iran's energy economy, but as a possible transition from military escalation toward economic pressure. And that changed the risk premium. The oil market basically said, if Washington is choosing sanctions instead of immediately expanding the war, maybe the probability of an even larger supply shock has fallen. That is a very different interpretation. The sanctions may be bad news for Iran, but they can simultaneously be interpreted as good news for global oil consumers. And that is where the idea of backfire becomes interesting. Because imagine you are an oil trader. You have two possible futures. Future number one, the United States launches another major military operation. Iran retaliates. Shipping through Hormuz becomes even more dangerous. More tankers stop moving. Oil supplies fall. Prices explode. Future number two, Washington chooses financial pressure. Iran suffers economically. But the conflict does not immediately expand. Oil continues moving through alternative channels. Saudi Arabia and other Gulf producers adjust logistics. China searches for replacement barrels. And the market begins pricing and stabilization. Which future would you rather bet on? Today, traders are increasingly betting on number two. Not because the crisis is over. It is not. Not because Iran is weak enough to ignore. It is not. And not because Hormuz is functioning normally. It is not. The market is simply saying that the probability of the worst possible outcome has declined. That is enough to move billions of dollars. But now we reach the second paradox. The United States may be hurting Iran's oil exports, while simultaneously making the remaining Iranian barrels more valuable. Think about that. If Iran could sell huge quantities of crude, competition would be greater. But if exports collapse, available Iranian barrels become scarce. Chinese buyers that still want Iranian crude may have to pay more. That is already showing up in the market. Recent reporting indicates Iranian oil offers to Chinese buyers have fallen sharply. Iranian exports have been severely disrupted, and Chinese refiners that traditionally relied on discounted Iranian crude have been searching for alternatives. This creates a bizarre situation. Washington wants to make Iranian oil less profitable, but scarcity can increase the value of the oil that still gets through. That is economics 101. Cut supply, hold demand constant. The remaining supply becomes more valuable. So sanctions can reduce the number of barrels Iran sells while increasing the bargaining power attached to the barrels that survive. And that leads to our next question. Who is actually buying those barrels? China matters enormously. China has historically been Iran's most important oil customer, and Beijing does not necessarily view American sanctions the way Washington does. For Washington, sanctions are a tool of pressure. For Beijing, sanctions can become a negotiating variable. Imagine a Chinese refinery that has several possible suppliers: Iranian crude, Iraqi crude, Brazilian crude, Russian crude, Gulf crude, African crude. If Iranian oil becomes harder to move, Chinese buyers simply begin comparing prices. And this is where Iran's discount becomes important. When sanctions increase the difficulty of selling Iranian crude, Tehran often has an incentive to compensate buyers with cheaper prices. That discount can make Iranian barrels attractive. So the very policy designed to isolate Iran can create an economic incentive for certain buyers to keep looking for Iranian oil. Not because they support Tehran, not because they support Washington, but because they want cheap energy. That is one of the oldest rules of international commerce. Money has a way of finding a path. And this is where sanctions become much harder to enforce than they look on a map. You can sanction a company, then another company appears. You can restrict a bank, then another payment route appears. You can target a tanker, then another tanker carries the cargo. You can pressure a country. Then that country asks, what do I gain by obeying you? And this is especially important when the commodity involved is oil. Oil is not a luxury product. It is the bloodstream of modern industry. Factories need it, trucks need it, ships need it, airlines need it, chemical companies need it. Governments need the tax revenue generated from it. So when one major supplier disappears, the market does not simply accept the loss. It starts looking for substitutions. That is why the sanctions game is not simply America versus Iran. It is America versus Iran, with China, India, Gulf producers, shipping companies, refiners, banks, insurers, traders, and consumers all making their own calculations. And every one of those calculations can change the outcome. Now let's talk about the Strait of Hormuz, because this is where the story becomes much more dangerous. Before the war, Hormuz was one of the world's most important energy corridors. Roughly one-fifth of global oil and LNG flows passed through the waterway. That made it strategically important. But the war changed everything. Traffic collapsed. Some ships stopped entering. Some companies rerouted. Others waited. And Iran gained a powerful form of leverage. Not necessarily because Iran can control every barrel that moves through the strait, but because Iran can make the cost of moving those barrels much higher. That is enough. You do not need to physically stop every tanker. You only need to convince enough tanker operators that the risk is unacceptable. Once insurance premiums rise, once crews become nervous, once banks become reluctant to finance cargoes, once ship owners begin asking whether the voyage is worth it, the effective supply of oil can shrink even if the oil physically still exists. That is what makes Hormuz so important. It is not simply a geographical bottleneck. It is a psychological bottleneck. And here is where America's latest strategy creates a dangerous contradiction. Washington wants economic pressure to force Iran to give up leverage. But economic pressure can also increase Iran's incentive to use the leverage it still has. If Iran is losing oil revenue, what does Tehran have left? It has geography. It has the Strait of Hormuz. It has regional relationships. It has missiles. It has shipping leverage. And it has the ability to create uncertainty. That does not mean Iran will shut down the strait completely. In fact, doing so could hurt Iran as well. But Iran does not necessarily need a complete shutdown. It only needs to convince the market that a complete shutdown is possible. That possibility itself can affect prices. And that is why the market reaction today is so fascinating. Oil is falling more than 3%, while the underlying geopolitical risk has not disappeared. The market is telling us, we believe the immediate risk is lower than we feared. Not, there is no risk. That distinction could become critical. Now let's look at the numbers. Iranian oil exports have been severely reduced. Recent estimates cited by Reuters indicate Iranian shipments had fallen to roughly 534,000 barrels per day in August, compared with an average around 1.4 million barrels per day in 2025. That is a dramatic decline. And Iran's export infrastructure has also been affected. Karg Island, Iran's major oil export terminal, has seen prolonged inactivity. Tankers are not moving the way they once did. So if Washington's goal is to reduce Iranian oil exports, the policy is clearly having an effect. There is no serious argument that sanctions and blockade pressure are irrelevant. They are not. Iran is under enormous economic pressure. Fuel shortages have appeared. Inflation is extremely high. The Iranian rial has weakened dramatically, and Tehran faces a serious fiscal challenge. So why call this a possible backfire? Because defeating an economy is not the same thing as achieving a political objective. That is the difference most people miss. Suppose Iran loses billions of dollars in oil revenue. That sounds like success. But what if Iran responds by becoming more aggressive in negotiations? What if it refuses to reopen Hormuz without concessions? What if it demands sanctions relief? What if it demands compensation? What if China becomes more important to Iran? What if Russia gains more influence? What if Gulf countries become even more nervous about the security environment? Then Washington may have achieved economic damage without achieving strategic surrender. That is not necessarily failure, but it is not the same as victory. And this is where the phrase backfire needs to be used carefully. The sanctions are not obviously failing. They are creating real pressure. But pressure can produce two opposite results. It can force compromise, or it can convince the target that compromise is too dangerous. We do not yet know which direction Iran will choose. And there is another reason oil prices can fall even while the geopolitical situation remains dangerous. Inventories. The world has buffers, not infinite buffers, but buffers. Strategic reserves exist. Commercial inventories exist. Tankers already at sea exist. Alternative suppliers exist. Refineries can change crude blends. Countries can alter import patterns, and traders can anticipate future production changes. That means the market does not look only at today's barrels, it looks weeks and months ahead. If traders believe Saudi Arabia, the United Arab Emirates, the United States, and other producers can compensate for some disruption, the fear premium declines. If traders believe a diplomatic channel could eventually reopen Hormuz, the fear premium declines. If traders believe the conflict will remain contained, the fear premium declines. And once the fear premium starts disappearing, oil can fall surprisingly fast. That is why a 3% move is not necessarily a contradiction. It is the market repricing risk. But here's the trap. Lower oil prices can make politicians think the crisis is under control. That can be dangerous, because lower prices can hide the physical stress inside the system. Look at shipping. Look at refinery disruptions. Look at insurance. Look at the number of vessels willing to transit the region. Look at the routes being used. Look at floating storage. Look at the inventories being consumed. These indicators can tell a different story from the headline price. And that is why we should not treat today's oil price as proof that the crisis is over. Oil is a forward-looking market. It can price a future peace deal before the first handshake. It can price a future war before the first missile. And it can change its mind tomorrow. That brings us to the third paradox. The lower oil price may actually reduce pressure on Washington. Think about the political implications. If oil stays near $90 or $100, consumers feel it. Gasoline becomes more expensive. Transportation costs rise. Food becomes more expensive. Inflation becomes harder to control. Interest rates become more difficult to manage, and voters notice. But if oil falls toward the low $80 for WTI, the political pressure eases. That gives Washington more room to maintain sanctions. It gives the administration more time. It gives consumers some relief. So, from Washington's perspective, today's oil drop is not necessarily bad news. It could actually be strategically useful. America may be applying pressure to Iran while simultaneously reducing the immediate inflationary cost of that pressure. That is a much more complicated picture than simply saying sanctions failed. They did not necessarily fail. The market reaction simply shows that sanctions and oil prices do not move in a straight line. Now consider the opposite scenario. What if oil had jumped 10% today? What would that tell us? It would suggest traders believed sanctions were increasing the probability of a broader supply disruption. That could create another cycle. Higher oil prices, higher inflation, more pressure on central banks, higher borrowing costs, lower economic growth, more political pressure, and potentially even more geopolitical tension. That is the nightmare scenario. So when oil falls 3%, traders may actually be celebrating the absence of that chain reaction. This is why financial markets sometimes react positively to bad geopolitical news. It sounds irrational, but it isn't. If the news is bad, but less bad than expected, prices can rise. If the news is aggressive, but reduces the probability of an even worse outcome, prices can fall. The market does not ask, is this good or bad? It asks, is this better or worse than what we had already priced in? That is the key. And right now, traders appear to be saying, the United States has chosen economic pressure. Iran is under severe strain, but immediate military escalation may be less likely than feared. Therefore, the risk premium can come down. That is why the headline is so counterintuitive. America announces tougher sanctions. Oil falls. It sounds backward. But once you understand expectations, it makes sense. Now let's turn to Iran, because Tehran has a very different problem. The country cannot simply replace lost oil revenue overnight. Its economy has already been weakened by years of sanctions. Its energy infrastructure has suffered. Its refining system has been damaged. Its currency has collapsed. And ordinary people are feeling the consequences. Recent reports describe long queues at petrol stations in Tehran. That sounds strange. Iran is a major crude producer, so why would Iran have fuel shortages? Because producing crude oil is not the same thing as producing enough gasoline. A country can have huge crude reserves and still have inadequate refining capacity. Iran has historically relied on imports for some refined petroleum products. When war damages refining capacity and a blockade restricts imports, the problem becomes much more serious. This creates a second layer of economic pressure. Iran is not simply losing export revenue. It can also struggle to provide the fuel its own population needs. That is a much more direct form of economic pain. But again, pain does not automatically equal surrender. History is full of governments that became poorer without becoming politically weaker. Sometimes economic pressure creates compromise. Sometimes it creates nationalism. Sometimes it strengthens the argument that the country is under attack. Sometimes it pushes a government toward alternative partners. And sometimes it makes leaders more willing to take risks. That is why the United States has to balance two objectives: pressure Iran enough to negotiate, but not so much that Iran decides there is nothing left to lose. That is an extremely difficult balance. And the Strait of Hormuz sits directly in the middle of it. Now imagine a negotiation room. Washington says, lift restrictions on the strait. Tehran says, lift sanctions first. Washington says, stop threatening energy shipments. Tehran says, stop the blockade. Washington says, return to international trade rules. Tehran says, end the economic war, and every side believes the other side should move first. This is the classic problem of geopolitical bargaining. The economic tools are powerful, but the bargaining problem remains. And that is why today's oil move should not be interpreted as the end of the conflict. It is better understood as a signal that traders believe diplomacy or containment may have become more likely than catastrophic escalation. But signals can reverse. Now let's bring China back into the story. Because if Iran's oil exports are being squeezed, China has a choice. It can comply with American pressure, or it can continue buying Iranian crude, or it can do some combination of both. That decision matters enormously, because China is not simply another oil buyer. It is one of the world's largest energy consumers, and it has its own strategic relationship with Iran. If Washington pushes Beijing too aggressively, the sanctions problem can become a broader US-China confrontation. That could transform an Iran problem into a global trade problem. And then the economic consequences become much larger. Imagine sanctions expanding. Chinese banks become targets. Chinese shipping companies become targets. Chinese refiners become targets. Iranian oil becomes harder to finance. But Chinese demand does not disappear. The result could be a shadow market, more complex shipping, more complicated payment systems, more opaque ownership, more intermediaries, more discounts, and more difficulty for Washington to determine exactly where the barrels are going. That is the unintended consequence of trying to control a global commodity network. Oil is fungible. A barrel of crude does not care what passport the refinery has. If China buys less Iranian oil, China buys another country's oil. That other country can then sell to someone else. The global system rearranges itself. That means sanctions can be very effective at reducing Iran's direct revenue without necessarily removing the same volume of oil from the global economy forever. This distinction is crucial. If sanctions reduce Iranian exports by 1 million barrels per day, but another producer increases exports by 800,000 barrels, the global supply loss is much smaller than 1 million. That is why Saudi Arabia, the UAE, the United States, and other producers matter. Spare capacity matters, inventory matters, alternative routes matter, and expectations matter. There is also another hidden factor: demand. If oil prices stay high for long enough, demand can weaken. Consumers drive less, businesses become more efficient, factories change processes, airlines adjust schedules, alternative energy becomes more attractive, electric vehicles become more competitive, and economies slow down. So high oil prices contain their own correction mechanism. The higher the price goes, the more aggressively consumers search for ways to use less. That is another reason the market may resist extreme prices. It does not mean prices cannot spike. They can. But the global economy is not static. It adapts. And that adaptation is one of the reasons oil markets can survive disruptions that initially appear impossible. Now we need to address the phrase in our title. Is America's Iran strategy backfiring? The honest answer is partly. Possibly, but not in the simplistic way social media might suggest. If backfiring means the sanctions are causing Iran to earn more money, there is little evidence for that. Iran's oil exports have been severely damaged. Its economy is under enormous pressure. Its fuel system is strained. Its currency is weak. So on the narrow economic battlefield, Washington is clearly inflicting damage. But if backfiring means the pressure is creating strategic outcomes that Washington did not want. Then the argument becomes much stronger because the policy may be encouraging Iran to rely more heavily on China. It may be increasing the strategic importance of Hormuz. It may be pushing regional states to rethink their dependence on the United States. It may be encouraging alternative shipping routes. And it may be teaching the global oil market how to operate around sanctions. Those are long-term consequences, and they may matter more than today's oil price. Think of sanctions as a wall. The United States builds the wall higher. Iran looks for a tunnel. Washington closes the tunnel. Iran looks for a boat. Washington tracks the boat. Iran changes the ownership. Washington sanctions the owner. The owner changes. The payment route changes. The insurance route changes. The cargo route changes. Eventually, the system becomes more complicated. And complexity itself creates a problem, because the more complicated the network becomes, the harder it is to control. This is why sanctions are often most effective when many major economies cooperate. If everyone agrees to enforce the rules, the wall is strong. If several major economies decide the rules are negotiable, the wall develops holes, and China is potentially the biggest hole of all. But there is an even bigger strategic question. What does Iran actually want? If Tehran wants sanctions relief, then economic pressure might eventually work. If Tehran wants guarantees against future attacks, economic pressure may not be enough. If Tehran wants compensation, sanctions may make negotiations harder. If Tehran wants recognition of its influence over regional security, then Washington may be asking Iran to surrender something Iran considers essential. And if Tehran believes the United States ultimately wants regime change, then economic concessions could be interpreted as a path toward greater vulnerability. That is why negotiations can fail even when both sides are suffering. Pain does not create trust. Sometimes it destroys it. Now look at the market again. Brent around $89, WTI around $82. Those numbers are dramatically lower than the levels traders feared during the worst moments of the crisis. And that tells us something. The market believes global supply can survive the current disruption, at least for now. But for now is the most important phrase. Because the oil market is sitting on a knife edge. A single tanker attack, a major refinery shutdown, a new missile strike, a failed negotiation, a sudden closure of a shipping route, a new round of sanctions targeting a major buyer. Any of these could change expectations. And once expectations change, oil can move several dollars very quickly. So the biggest mistake investors could make now is assuming that today's decline means volatility is finished. It probably isn't. There is another clue hidden in today's move. Oil prices did not collapse because supply suddenly increased. They fell because the market reassessed risk. That means the rally can return just as quickly if the risk assessment changes. In other words, this is not necessarily a supply story anymore. It is an expectation story, and expectations can move faster than physical barrels. That is why headlines matter so much. One sentence from Washington can move crude. One threat from Tehran can move crude. One statement from Beijing can move crude. One tanker incident can move crude. One diplomatic meeting can move crude. The physical oil does not move that quickly. The price does. Now imagine the next 3 months. There are 3 broad scenarios. Scenario 1, diplomacy improves. The United States maintains sanctions but avoids further military escalation. Iran and Oman or other mediators find a mechanism for safer shipping. Some oil begins moving again. The risk premium falls. In this scenario, oil could remain under pressure. Scenario 2, the conflict stays frozen. Hormuz remains restricted. Iranian exports remain low, but no major new military escalation occurs. In that scenario, oil could remain volatile around a relatively high range. Prices would react to inventories, alternative supplies, and every new geopolitical headline. Scenario 3, the conflict escalates. Shipping attacks increase. Hormuz becomes even more restricted. Alternative routes prove insufficient. Major producers face additional disruption. Then today's 3% decline could look like a temporary pause before another surge. Those 3 scenarios are completely different. And the market is constantly recalculating the probability of each one. Now ask yourself, which scenario does Washington actually want? Probably not a total collapse of oil supply, because that would hurt America too. The United States produces a lot of oil, But Americans still consume enormous quantities of petroleum. Higher crude prices eventually affect gasoline, diesel, aviation fuel, transportation, and inflation. So Washington has an incentive to pressure Iran without destroying the global energy system. That is easier said than done, because Iran understands the same equation. Tehran knows that if it causes a huge oil shock, it may hurt itself. But Tehran also knows that if the United States fears a huge oil shock, Washington has to think carefully about escalation. That creates deterrence, and that is the strategic value of Hormuz. So perhaps the most important lesson from today's oil drop is not about Iran. It is about leverage. America has financial leverage. Iran has geographical leverage. China has purchasing leverage. Saudi Arabia has production leverage. Shipping companies have logistical leverage. Consumers have demand leverage. And traders have pricing leverage. Nobody controls the entire system. That is why the outcome remains uncertain. And that is also why the idea that one country can simply turn off another country's oil revenue is misleading. You can make oil harder to sell. You can make it more expensive to finance. You can make shipping more dangerous. You can make buyers nervous. But you cannot easily erase global demand. As long as somebody wants the oil, somebody will try to find a way to move it. And now we come to the biggest question. Could the falling oil price actually strengthen the U.S. position? Surprisingly, yes. If lower oil prices reduce inflation, if consumers get relief, if the Federal Reserve gets more room to maneuver, if financial markets calm down, and if Washington can maintain pressure on Tehran without triggering a supply shock, then the United States could gain strategic breathing room. Iran would remain under economic pressure. American consumers would not be paying the worst-case energy price, and Washington could keep negotiating from a position of strength. That would not be a backfire. That would be a successful balancing act. But there is a catch. It depends on the conflict remaining contained, and that is exactly what nobody can guarantee. The opposite is also possible. Imagine Iran decides that sanctions have crossed a red line. Imagine Tehran increases pressure on shipping. Imagine a major tanker is seized. Imagine an attack kills foreign sailors. Imagine several shipping companies leave the region. Insurance costs explode. Then oil traders suddenly reverse their assumptions. The market stops pricing containment. It starts pricing supply shock. Brent rises. WTI rises, gasoline rises, inflation expectations rise, and suddenly the same sanctions that produced a 3% decline yesterday can contribute to a major rally tomorrow. That is the paradox. The policy itself has not changed. The market's interpretation has changed. And this is why the next headline may matter more than today's headline. Watch the Strait. Watch Chinese purchases. Watch Iranian export volumes. Watch tanker traffic. Watch Saudi and Emirati production. Watch U.S. strategic reserves. Watch insurance costs. Watch refinery utilization. And most importantly, watch the diplomatic language. If Washington and Tehran start using words like framework, verification, temporary arrangement, or safe passage, oil traders may begin pricing de-escalation. If both sides start using words like retaliation, blockade, red line, or military response, the risk premium can return immediately. The oil market listens to politicians, but it listens even more carefully to what politicians might do next. There is also a lesson here for investors. Do not confuse the direction of oil today with the health of the global energy system. A falling price can mean oversupply. It can mean weak demand. It can mean rising inventories. It can mean reduced geopolitical risk. Or it can mean traders are simply taking profits. Today's move appears heavily connected to changing expectations around the U.S.-Iran confrontation. That means investors should be careful about extrapolating. A 3% drop is a data point. It is not a conclusion. And one day of price action cannot prove whether Washington's strategy is working. For that, we need to watch the physical economy. Is Iran still losing export capacity? Are buyers still willing to take Iranian crude? Can alternative suppliers compensate? Is Hormuz becoming more or less accessible? And is diplomacy becoming more or less realistic? Those answers will tell us far more than today's candle on a chart. Let's return to Iran's position. The country is under severe economic pressure, but Iran still possesses assets. It has huge hydrocarbon resources. It has a strategic geographical location. It has established relationships with Asian buyers. It has experience operating under sanctions. It has regional networks. And it understands that the global economy cannot easily replace Middle Eastern energy overnight. So Iran is weakened, but weakened does not mean powerless. And that distinction is essential. The United States may be winning certain economic battles, while Iran retains enough leverage to make the overall strategic outcome uncertain. That is why Washington cannot simply assume that maximum pressure automatically produces maximum compliance. Sometimes maximum pressure creates maximum resistance. Now think about the Iranian population. This is where geopolitics becomes human. When oil exports fall, the consequences are not just numbers on Bloomberg screens. They can mean fewer government revenues, less money for subsidies, higher fuel prices, longer queues, more inflation, lower purchasing power, more uncertainty, and greater pressure on families. That is the human cost of economic warfare. And it creates another political question. Will economic pain convince ordinary Iranians to demand compromise? Or will it convince them that the country must resist foreign pressure? Both outcomes are possible, and history does not provide a simple formula. There is a common assumption in international politics. If you make an opponent suffer enough, they will eventually surrender. But governments are not businesses. They do not maximize profits. They maximize survival. A company facing bankruptcy may sell itself. A government facing an existential threat may do the opposite. It may take greater risks. It may mobilize its population. It may seek new alliances. It may become less predictable. That is why sanctions are powerful, but also dangerous. They can create leverage. They can also create desperation, and desperation is difficult to price. So is America's Iran strategy backfiring? Let's break it down. Economically against Iran, the evidence suggests Washington is causing serious damage. Against Iranian oil exports, clearly. Against Iranian fuel availability, the pressure is severe. Against Iran's currency, the damage is substantial. But against America's broader strategic objectives? The answer is still unclear, because the policy is producing secondary effects. China is becoming more important. Hormuz is becoming more strategically important. Alternative shipping networks are becoming more important. And the global oil market is learning how to adapt to a world where a major energy corridor can remain partially restricted for months. Those adaptations could outlast the current conflict. And that is what policymakers should worry about. Because sanctions do not simply punish today's target, they also teach tomorrow's target. Every time a country finds a way around a sanction, someone else learns from it. Every alternative payment mechanism becomes a precedent. Every new shipping route becomes a precedent. Every new insurance arrangement becomes a precedent. Every new refinery that can process alternative crude becomes a precedent. Over time, the global system becomes more resistant to unilateral pressure. That does not make sanctions useless. It makes them less permanent. And that could be one of the biggest strategic consequences of the Iran crisis. Now imagine 5 years from today. Suppose China has diversified its crude suppliers. Suppose Gulf countries have invested more heavily in alternative export routes. Suppose tankers are using more sophisticated risk systems. Suppose Iranian oil has become deeply integrated into a shadow trading network. Suppose new payment systems exist outside traditional Western channels. Then the next time Washington announces sanctions, the market may react differently. Not because sanctions are weaker on paper, but because the world has learned how to adapt. That is how geopolitical power changes, not overnight, gradually, one workaround at a time. And this brings us back to the headline. Oil is falling more than 3%. It looks like Iran is losing. It looks like America is winning. But markets are rarely that simple. The immediate oil price says traders are less afraid of a wider supply shock. The physical data says Iran's oil industry is under tremendous pressure. The shipping data says Hormuz remains a major problem. The diplomatic picture says the conflict is unresolved. And the strategic picture says both Washington and Tehran still have leverage. All of those things can be true at the same time. That is the paradox. So what should we watch next? Number 1, Iranian exports. If they remain extremely low, the economic pressure on Tehran will continue. Number 2, Chinese buying. If Chinese refiners continue purchasing Iranian barrels despite American pressure, Washington's sanctions strategy becomes much harder to enforce. Number 3, Hormuz. If traffic increases meaningfully, The market may continue removing geopolitical risk from crude prices. If traffic falls again, the opposite could happen. Number 4, diplomacy. Any credible agreement could trigger another sharp decline in oil. Number 5, military escalation. A single major incident could reverse everything. And number 6, inventories. Because inventories are the bridge between a temporary disruption and a genuine global shortage. If inventories remain adequate, prices can stay controlled. If inventories become dangerously low, the market changes character. There is one more thing investors should understand. Oil markets do not need an actual shortage to create a shortage price. They only need fear that a shortage is coming. That is why the market can move before the physical problem appears. If traders believe next month's supply will be lower, they bid up today's futures. If they believe next month's supply will be safer, they sell today's risk premium. So today's decline is effectively a vote. The market is voting that the probability of catastrophic escalation has decreased. But votes can be reversed, and the next event can change the count. That is why I would not celebrate today's oil drop too quickly, and I would not panic about it either. The most useful interpretation is this: the market has temporarily chosen containment over catastrophe. That is good news, but containment is not peace. And economic pressure is not political victory. The United States may have succeeded in reducing Iran's oil revenues, but the bigger strategic question remains unanswered. Can Washington convert that economic pain into a durable agreement? If the answer is yes, today's oil collapse could be the beginning of a larger normalization trade. If the answer is no, today's decline could eventually become just another pause in a much longer energy crisis. And there is a final paradox. The lower oil falls, the less immediate pressure there is on the United States to change course. But the lower oil falls, the more time Iran may need to survive. That means both sides can interpret the same market move differently. Washington may see lower oil as proof that pressure is working. Tehran may see lower oil as evidence that global consumers are adapting. China may see an opportunity to negotiate better prices. Investors may see reduced geopolitical risk, and ordinary consumers may simply see cheaper gasoline. One price, 5 different interpretations. That is geopolitics. So no, a 3% oil drop does not prove that America's Iran strategy has failed, and it does not prove that America has won. What it proves is something more interesting. The market currently believes the next chapter of this conflict may be economic rather than military. And that belief is powerful. Because oil prices are not just measuring barrels, they are measuring fear. They are measuring expectations. They are measuring the probability that the Strait of Hormuz stays dangerous. They are measuring the probability that Washington and Tehran find a way to step back. And right now, fear is coming out of the price. But the underlying risk is still there. The real test comes next. If Iranian exports remain crushed while Hormuz gradually becomes safer and diplomacy advances, then Washington may have found a way to pressure Tehran without destroying the global oil market. That would be a strategic success. But if sanctions push Iran toward greater confrontation, if shipping becomes even more dangerous, if China refuses to cooperate, and if the strait remains effectively restricted, then the economic pressure could produce the exact opposite of what Washington wants. A weaker Iran, but a more unstable energy market. Less Iranian revenue, but greater Chinese involvement. Lower oil today, but higher geopolitical risk tomorrow. That is the possibility of backfire. And perhaps the biggest lesson is this: you can sanction a country, you can blockade a port, you can threaten buyers, you can target tankers, you can squeeze an economy, but you cannot sanction geography, you cannot sanction global demand, and you cannot permanently remove the incentives that make people trade. As long as oil is valuable, someone will try to move it. As long as Iran controls a strategic position near Hormuz, someone will have to negotiate with Iran. As long as China needs energy, Beijing will have a reason to keep searching for supply. And as long as the United States wants to control the global financial system, Washington will continue using sanctions as one of its most powerful weapons. The question is not whether that weapon works. It does. The question is what happens after it works. Because pressure creates a reaction, and the reaction is where strategy is decided. Right now, that reaction is sending a strange message. Oil is falling. Iran is hurting. Washington is escalating economic pressure. But traders are becoming less afraid of immediate catastrophe. That is why the market can move down while the geopolitical situation remains extremely dangerous. It is not a contradiction. It is a repricing of probabilities. And if those probabilities change again, the price can change again. Fast. So keep your eyes on the next few weeks. Do not just watch the headline oil price. Watch the barrels, watch the tankers, watch Hormuz, watch China, watch Iranian exports, watch inventories, watch Washington. And above all, watch the gap between what politicians say and what the market believes they will actually do. Because that gap is where oil prices are being decided. Today, the market believes escalation may be slowing. Tomorrow, it could believe the opposite. And if that happens, the same oil market that just dropped more than 3% could turn violently higher. That is why this story is not finished, not even close. The bigger question is no longer, can America hurt Iran? The answer is clearly yes. The bigger question is, can America hurt Iran without creating a larger problem for everyone else? That is much harder. And the answer will depend on whether Washington can maintain pressure without triggering another supply shock, whether Tehran chooses negotiation over escalation, whether China cooperates or circumvents, and whether the Strait of Hormuz becomes a pathway for diplomacy or the center of the next energy crisis. For now, oil traders are betting on restraint. But the Middle East has repeatedly shown how quickly restraint can disappear. So today's 3% collapse is not the end of the story. It may be the market telling us that the worst-case scenario has been pushed further away. Or it may simply be the calm before the next repricing. And that is exactly why the next move in oil could be much more important than today's move. If you want to understand where oil goes next, don't ask only how much crude Iran can export. Ask a much bigger question: who controls the risk? Because in this crisis, the country that controls the risk may have more power than the country that controls the oil. And right now, that battle is still being fought. In Washington, in Tehran, in Beijing, inside the tankers moving through the Gulf, and ultimately inside the price of every barrel of crude. So the oil is falling. Iran is under pressure. America is tightening the economic noose. But whether that pressure produces surrender or creates a new geopolitical order is still the trillion-dollar question. And the answer may be hidden not in today's 3% decline, but in what happens next.